You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Monday. Today, we're going to talk about a stock that more than tripled in value over the past 3 years, right after going down in free fall over the past 6 months. So this stock is currently down by more than 35% over the past 6 months, but yet showing a stock, a total return of almost doubling its price over the past 3 years. So what's going on, and should you invest? And on top of that, forgot to mention the most important part, right? It's a dividend stock paying a yield almost at 9% with monthly distribution. Kind of crazy, right? So I am talking about Decisive Dividend Corporation. The ticker is DE.V, so it trades on the TSX Venture. So this means it's a small cap. And by small cap, I mean ultra small cap. We're talking about a market capitalization of $117 million. So very small, tiny company. Used to trade after COVID like around $1.40, $1.50, went up all the way up to $11 in March of 2024. Became one of like dividend investors' darling, because we know we're always looking for the new stuff. And now from $11, it's all the way down to $6, and I'm not too sure if it's going to stop there. So the question is, from many followers, was, Mike, what is going on with this Decisive Dividend? I got this one on my radar a couple of times because a lot of members were asking for it as well, and I was a bit reluctant. I was reluctant because I remember Sylogist, and Sylogist was pretty much the same thing. Actually, it showed like a long story of dividend growth, like 8 or 9 consecutive years with a dividend increase. A little bit smaller, a little bit bigger, but used to trade on the TSX Venture, became on the TSX, like the regular TSX after that. But long story short, the stock surged and then crashed, and now it's on kind of like a recovery path, but it cut its dividend, and I'm like not really interested anymore. So this one kind of hurt my feeling, kind of hurt my ego, because I did a good move on Sylogist and then lost money in the end. So wasn't super surprised. So this is the reason why I've put this one on the shelf, looking at it a little bit. But today I just wanted to do like a bigger deep dive. So the business model, kind of like simple. It is a growth by acquisition company. So see it as like a holding company. They focus on buying small businesses in the manufacturing industry. So up to 25 million. So very small acquisition, one after the other. They made like 13 acquisitions in 9 years. And their goal is not to get rid of those and sell them right away, but rather use their playbook to build a better business and to keep on operating it. So it's a interesting proposition that they give to the vendors, where a lot of entrepreneurs right now do not have any means to sell their businesses. They don't know what to do. They're getting old or tired, and they just want to sell, but it's hard to sell, especially in the manufacturing business. So this is if Dividend they come in to save the day, keep the employees working at the same place, and just grow the business. Someone, like one investor even said, well, it's like Constellation Software business model, but instead of like buying small tech, they are buying small manufacturing companies. I'm like, yeah, business model wise, it is similar in a sense that that's what they do. They focus on like small deals and they grow, but the comparison, unfortunately, pretty much stops there. When you look, and you know, I just love to look at the Dividend Triangle. So when you look at the Dividend Triangle, you notice that the revenues were not growing that fast for the first years. Earnings per share were pretty much flat. So I'm talking between like 2015 and 2020. So before the pandemic, we didn't have like a crazy a crazy growth period here, and that is like already one source of concern for me. Then we had that amazing period after COVID where everything was completely crazy. So that's interesting to see how fast everything like traveled after COVID, but that could be explained because they likely probably got a lot of great deals, and then they were able to start with a revenue, like total trailing month revenue of like roughly 50 million at the end of 2019, all the way up to 130 in 2023. However, this year so far, it's pretty much flat and earnings are going down. So that probably explains why now the market doesn't like it that much and it's in free fall. Well, we see revenue stagnating, we see earnings declining, and we see that after a long while of like great dividend growth between 2022 and 2024, now we may not see generous dividend increases. Not too sure what's going to happen. So we had one at the beginning of the year, and now it has been stable. So I'm not saying that the dividend is at risk, but we can see that the three metrics are slowing down, while like in 23 we had like 2 dividend increases. This year, it doesn't sound like it's going to happen, especially because earnings are slowing down. So now we have an interesting narrative, a good business model, relatively easy to understand, and there's like plenty of entrepreneurs looking to sell their businesses. So that kind of all makes sense. The balance sheet is not that bad either. They have some liquidity on the side. They do not have like huge debt yet. It's like they finance like 50% in equity, 50% in debt. But the biggest risk I see here is how the capital has been allocated. So a lot of people say, oh, it's like Constellation Software. Okay, so what Constellation Software does with its dividend? Well, they kind of like forget about it. So they're paying like a ridiculously low dividend. You know why? Because they're using their cash to buy more businesses. What's the case with DE? Well, Decisive Dividend is actually paying almost a 9% yield with monthly distribution. So instead of using their cash to make more acquisition and to actually like go on that huge long list of pipelines of potential vendors, they are redistributing money to their shareholders. Like for me, for a very small business, so definitely they're not lacking of potential candidate to make other acquisition. The market cap is less than $1 billion, way less actually. I had at 117 million at the time of recording. So super small cap company that is supposed to be based on growth, and they are distributing a big share of their profit to the shareholders. I'm not too sure I get that point. Actually, I would have been a lot more excited by DE if the company would not grow their dividend and would focus on growing revenue and earnings more aggressively by making more acquisition, since this is their business model. So while the idea behind Constellation Software is, well, we have so much interesting pipeline, like companies in the pipelines, that we need all the cash that we have to actually make those acquisitions and generate a lot more value for shareholders. We have exactly the opposite with Decisive, and that bothers me a lot. So you can say that I would definitely tell you that it's a hard pass for me. And actually, it's kind of interesting because I do have some money on the side right now. I have about like a $10,000 that I want to invest. And the way I'm going to do it is I'm going to use the Rockstar List instead. So the Rockstar List is a list that I update every month for all readers. So you just have to subscribe for free for my newsletter, and you're going to receive the update monthly. The list is being built with DSR Stock Screener. Of course, I have like a lot more metric on my side, which members can build their own Rockstar List and actually modify it as they wish and add up to 50 financial metrics to it. But the Rockstar List basically is a list of companies on both Canadian and US market that shows positive revenue growth, earnings growth, and dividend growth over the past 5 years. So the idea is to pick among the best basket of companies, those that have been thriving over the past 5 years. This dividend would make the cut right now because all the numbers are up, but you can see that you need an additional layer to make sure that you understand the business and you identify the risk. For me, the biggest risk for DE is definitely the fact that they're paying way too much in dividend instead of concentrating on their business. If you want to get more ideas from the Rockstar List and receive it monthly in your mailbox, just go on moosemarkets.com/rockstars. That's moosemarkets.com/rockstars, and you will download it right away. And after that, every single month, we're going to send you the list. It's an Excel spreadsheet, super easy to use, and you can filter it. I would suggest that you filter it by dividend growth. That's the number one key metric for me. But then, of course, you need to do some due diligence and realize that not all great stocks with great metrics are actually fit for your portfolio. All right, Moose, I hope that you have enjoyed this podcast. We're going to talk again tomorrow morning. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.